Hello, everyone. Welcome back. It's your boy here, TB S&B. Happy Sunday. Like I did last Sunday, I'm going to do a little video just talking about grand scheme of things, big picture kind of things, talk more about fundamentals and technicals. Even though I really didn't talk much about the end of the week, we can brush over it real quick. Friday, we got that PC number, and it was abysmal. It was as bad as everyone kind of expected, and we kind of knew that because PPI and CPI were so bad. We were kind of expecting that, but the price action we had intraday was sort of interesting. We did get that massive gap down, but we kind of just grinded to the upside. I mean, we didn't just completely rug pull. We did run straight down to this key level at 393.60, which you can see was a past resistance over here. So that was notable and is an obvious supply zone. You can see right there. Perfect. Boom, supply zone right there. We ran right down to it and bounced off of that on pretty high volume. This was very, very high volume selling. This was the highest volume that we've seen since back in December, actually, on the S&P. So that was very interesting. But you can also see we're right above that 200-day moving average. We did lose the 50-day moving average, but that 200-day moving average is the big one. That's the one that we have to hold. And now also when you zoom out on our little trend here, I'll try to clean up my chart a little bit so you can actually sort of see what's going on, because it is a bit of a mess. If you look back, this big downtrend line, we are back below that, actually. So we have lost the break of this downtrend that we had formed all year last year in 2022. We have lost that. We have now broken our last ditch support line that we had here, coming from the bottom in October, coming up here to this consolidation we had at the end of the year last year. We have lost that line on very high volume. So now, to me, this level, the supply zone, right on top of the 200-day moving average, that is massive. We start seeing SPY below 390, and I'm really, really amping up my bearish sentiment price action wise. Right now, I'm more bearish than I've honestly been at any point right now. All the data is pointing towards things just getting worse and worse and worse, while the market was delusional, going up. Bond market knew things were getting worse, but to me, there is no more better reason to be bearish than there right now. Like, there are no more better, more reasons to start thinking bearishly on the market than right now. And I'm going to talk about that this video. We're going to chat all about that, why I think that. Nasdaq, we ran right to our 200-day moving average on the Nasdaq, put in this nasty little doji right here. So the Nasdaq is kind of doing what we expected. The high interest rate stuff always hurts tech the most, so that was pretty apparent that when inflation pumps back up, that means higher rates for longer, and that means tech is going to see more pain. So tech, the Nasdaq 100, we ran right down to our 200-day moving average. Like I told you guys on my last video, I said 290. You have that confluence. You have this massive, if we zoom in on the hourly, we have this massive supply zone right here. You can see over here on the hourly, huge supply zone on top of the 200-day moving average that's sitting right there. So 290 is everything for the Nasdaq right now. But same thing, we just gapped down on Friday and literally just chopped sideways with massive wicks to the upside on the hourly, which really kind of tells me that the bears were just saying, nah, we're not getting a midday pump on this here market today. And looking at the 15-minute, I mean, it was just disgusting. It was just up and down, up and down. So consolidating. And now the bears are really just going to wait for the next reason to start selling stuff off. And for me personally, I think we're going to start hearing some Fed members start to talk a little more hawkishly now that we got a massive pump up in inflation from all of our metrics coming in this last week. I think that will be the next push in that direction. At this point, I'm honestly not sure what could push the market up besides just general technicalities. I mean, you can't just go straight down. The market's going to ebb and flow and do this. I mean, this on Thursday was crazy. We were making 292. We'd run up to 298. We were making intraday 2% moves to the upside on the Nasdaq. So there are still buyers, but the fact that we got this much buying, PC just comes out, wipes it all out, is a little concerning. Also very high volume selling on the Nasdaq. Not the highest like on the S&P, but it is looking like the Nasdaq is going to start leading the market down. But I'm going to wait for 290 to break. That, to me, will be where Yeah, it's looking like we're heading back down towards these lows at 260. Absolutely, if we see a solid break of 290. But right now, I kind of expect a bounce. Price action doesn't look as bearish as the fundamentals, so I would expect a bounce from here. A small bounce, maybe up to 296 or 297-ish before we take our next push back down. But let's talk about why I think that. So here on my nice little professionally made PowerPoint right here, we got the 4 big ones I like to talk about. The 4 big ones that the Fed talks about, that's all they look at. We got PCE, that's number 1, that's king, which came in terribly on Friday. CPI, PPI, unemployment. Let's just go over all of them. So first things first, here we go. Here's our data for our PCE month over month changes that we had since last year. So this is January of 2022. We're sitting here at this 0.5, 0.6, 1% in March. We knew March was going to be terrible. Ukraine war, it was bad in March. We come down from that 0.2 in April, and then what happens? We start to see this ugly. We go back to 0.6. We go back to 1. Now this April, May, June was the worst stretch of last year. If anyone remembers all the way back then, I know it's a long ways all the way back then. This was when the market was really making the bulk of its push down, starting here at the end of March, ending over here in June. Over this 3-month stretch, we lost about 27.5% on the Nasdaq, about 20% on the S&P 500. This was really bad. This was when uncertainty was very high. We didn't know how high the Fed was going to go. We thought inflation was still transitory. We were still holding on to that. Yeah, this inflation was kind of just, we think it was caused by the Ukraine war. We thought it was just gas, but then it became clearer and clearer that it is becoming entrenched, and it is broad-based. It is through all sectors. So we got that 1% in June. That was terrible. June was, as you can tell, a terrible month. We bottom, and then we start making our push. We get that summer rally, and the inflation numbers supported it because we go from 1% in June to that negative 0.1% in July, that 0.3% in August, 0.3%, and then we start to bump up in October. But the other numbers kind of support why we bottomed in October. PCE was pretty tame. So what is really notable now is that we have jumped up to 0.6 after the past 6 months have been below 0.5. We have made a big pump to 0.6. And that happened over here back in April. We were at 0.2. We go to 0.6. And June was 1. We get rug pulled. That was nasty. Back here in January, we go from 0.5 to 0.6. We go to 1. So not that you can look at this and be like, well, if you look at the pattern, we should get a 1%. I'm just saying that when you are trading stocks and you're seeing a trend, things going down, and then you see a big push to the other side, you start to worry about that counter trend, that thing, that flip, you start to worry. And this is exactly what I'm talking about when it comes to PC, is that I'm starting to worry because if we boil it down to the actual parts of the PC numbers, I can't even talk right now. If you look at the things like goods, so goods was coming down 0.4% through July, 0.3 in August, 0.1 coming down. October, it bumps up. And you look at the price action in October, and that's where we bottomed, was back here in October. This was CPI day, but we start to bottom over here in October because it's looking bad. It's looking really bad. And then it starts to come down, negative 0.2, negative 0.5. So goods was coming down, and goods is the very volatile thing. So this was pushing down PC a lot, was goods. This was the main thing, and it got so high because of those oil prices. So really, it's kind of what I've been talking about. Oil prices coming down has been pushing this entire the entire story for inflation. It's been pushing the whole thing down. It's been all oil prices. It's been all goods. And now we went from negative 0.5 to 0.6% over the month of January on goods. So that's like a full 1.1% swing to the upside on goods, which is pretty rough, if I do say so myself, because that was the main thing pushing it down. Like I just said, it was goods. And the Fed knew that. They would keep saying, yes, we like that goods is coming down, but we know that's super volatile. We need to see services. So if we look over here at services has just been sticky, icky, man. It has been rough. It is, I mean, it starts boiling up early in the year, 0.3, 0.3, 0.5 in March, and then we're just staying there. We're at 0.5, 0.4, 0.4, 0.7, and then we come down in July. Nice. So what's the market do? We rally. But then August, we tick back up, and it's just always been sticky right there at that 0.5% month over month, which is very, very high. You think about, I mean, 0.6 annualized, that's a lot. That's a lot of inflation on the service side. So we're not seeing that service side. That's really bad. You don't like to see that. But if anything you can take away from this, it is that now it's clear that we have done what we did back in June and July, where the market kind of was just like delusional. We were just like, hey, we see these inflation numbers coming down. What if that was it? What if it was transitory? And then what happened? The second it pumps back up, coming here in August and September, the second we start to see it pumping back up, the market just shits the bed. So we're kind of sitting right there at that point over here now. But this time is a little different. This rally was much stronger to the upside. There was actually some institutional buying on this, and we did break the previous high, but we've already given up that previous high now. So that's PCE. Next up, we got CPI. CPI, I mean, Fed doesn't give a rat's ass about it. The stock market does, because it is just a crazy volatile, like they love to cook your options kind of day on the CPI. But same thing on CPI. January, we bump up. We go from 0.1, which actually the initial release back in January for the December CPI was that we went down 0.1 for the 1 month change. But then they revised it, and it was actually, we went 0.1 up. So we thought it was a negative, but we actually went up 0.1. And now we're back up to 0.5, which is the highest that we've seen since October. And it's kind of looking like what happened back here in September and October. Now we are bumping back up after a couple months of it going down with the market rallying. We're coming back up, man. Not good. You don't like to see that. Yeah, and you can really see right there. Ugh. So CPI, same thing as PC. We're coming back up. Jumping over PPI. PPI was abysmal. There is no sugarcoating that. This one was shockingly bad. If you look right here, this is our month-over-month changes. We were seeing some real dropping on the PPI side of things, which is great. Producer price index. It was at 0.3 through September, October, November, so it was kind of a non-factor. It was like it was there, but it wasn't nearly as big as CPI. It wasn't nearly as big as PC, and it was just there helping the whole bull case that, yep, it's coming down. We're good. Because we had a negative read in December. It was a negative read. But January, we shocked to the upside. We shoot up 0.7, which is the highest since June of last year. Not good. Not good at all. So that has totally rug pulled that idea that is coming down. And it's the highest. I mean, we went from negative 0.2 in December to 0.7. So now, yes, we've gotten one really bad month of inflation. Is this proof that it is over, that we are going back down because inflation is becoming entrenched? I don't think so yet. I think we need to see another set of data. We need to see what inflation data is for this month, February, which will come out in March. I know that's a long ways away, and there's going to be a lot of price action in between then. But in my opinion, if we do get another red hot read for February, then we are going down, baby, because that will be proof that this wasn't just a fluke. It wasn't just like January was a hot month because of the holidays or something. Who knows? It'll be proof that that wasn't the case, that we are actually going back to that high inflation trend. So I would love to see next month's and really make my long-term stance based off of that, because if those come in red hot, then the Fed is really going to start changing their tone, because they're also the same way. They're not going to completely change everything that they've been talking about just for one bad month of inflation. I think people think they will. I think the bears want to be early to the move, so they are saying that, yes, the Fed will start to rug pull, but I do not believe so. I don't think they're going to go from being quite dovish to immediately being hawkish and just trying to destroy everything. I don't think they're going to do that. That's why the market is pricing in the possibility of a 50 basis point hike right now. I do not believe that they will do 50 basis points. I think that will be, they should. I should say that. I think they should. I think they should be shitting their pants right now, because they were looking like heroes. Everyone was cheering for him. Everyone's like, they did it. They got the soft landing. Everyone was thrilled. And now we see inflation spike back up in a massive, huge way, we see inflation spike up massively to the upside, they should come out next FOMC and be like, hey, we thought we were kind of in the clear, but it's apparent we're not. I don't think they'll do that. I think they will be pussies about it like they have been, and the market will suffer for it, but that will be all right. So right now, yeah, we have a 27% chance that they do 50 basis points. I really don't even think it's that high. I think there's like a none chance that they'll do it, but the bond market, the Fed funds futures are pricing in that possibility right now. So you can't ignore it, even though I don't think it's going to happen. But next FOMC meetings in 23 days. So they'll have 2 months of, I believe, let's see. I believe they'll have 2 months of inflation data to go off of. Reference month for February. Yeah, so we're going to get that CPI March 14th. So they'll have 2 full months of inflation data to look at before they make their next decision. I think that's why people are thinking they could do 50 basis points, because they didn't have a meeting for February. So they'll catch up because they would have done one if there was a meeting in February, I'm sure. So if we do get that bad inflation read in March, they'll have 2 months of rising inflation to really support this theory that it is becoming entrenched and that it was just another little dip that we saw back in August or that we saw back in July and August. It was just another little fake dip because things got so hot, and that inflation is actually becoming entrenched. And that's the big fear, is that how many times can we do this? How many times can we go from high inflation till it comes down, till everyone's running across the finish line thinking, yep, we got it, we're good. And then it comes back up. How many times can we possibly do that before inflation becomes completely entrenched and then it becomes way, way, way harder to get rid of, which it is doing that slowly over time. So right now, that's kind of what I'm thinking right now. And just from an earnings standpoint, I know outlooks look pretty good for some of these companies. Not great, but they're not terrible. But right now, we're not on the tail end of these rate hikes. People think we are because they're going to start slowing down. They think they're going to pause and reverse by the end of this year. I think that is crazy. I think there's zero chance of that. And I think once the market realizes that they're not going to start cutting rates by the end of this year, unless something terrible happens, unless there is an absolutely catastrophic black swan event, I think once that reality sets in on the market, that we're going to see a lot of pushing down. We're going to see new bottoms on that, because I think that is the only reason the market went up in the first place at all, because we got earnings. They weren't horrendous. We're getting inflation data supporting that it's coming down. We're getting all these good things happening, that the Fed is actually going to start cutting rates, right? And then we get shit on with a big fat inflation report that ruins everything. I think it's crazy to think that we're going to see rates cut by the end of this year. But what I was saying, we're not at the tail end of these rate hikes, because they're going to keep doing them, and they have a lagging effect on the economy. So things are just going to get worse and worse and worse as time goes on. People don't really talk about that. People think that, oh, they flipped the switch to hike rates, so therefore the effects are immediately felt. And that is not true at all. It is a lagging 6 to 12 months it takes to feel the full effects of each rate hike. So if you took that logic into account, we might not even be feeling the first rate hike from last year, barely, because that was only a year ago that we started getting these rate hikes. So as the months go on, the pain is just going to pile on. We're not in the end of this cycle. We are just starting to feel its effects. And I think that is why the market is so delusional, because it is just like completely convinced that we are going to start cutting those rates sometime soon, and the data is just not supporting it. And that's I lost my train of thought, but the data is just not pushing that narrative right now. So until it does, I would be very concerned. And if we do start to see higher targets, if the Fed comes out and says, yeah, we were aiming for 5, but we're probably going to start aiming for 6, maybe even 6.5, I think the market's going to, just all these things, that should make the market come down. This should make the market come down. I feel like a broken record here, but this is just nightmare scenario I'm kind of describing, but it's starting to look more and more plausible every day. And now we're starting to see high volume selling on the Nasdaq, kind of pushing that theory up a little bit. And we're seeing some stocks that are just doing, NVIDIA is the new Tesla. Tesla is more grounded in reality. Tesla actually makes some solid money. can make some revenue. Nvidia's over here at a like forward P&E of like 80. It's a half a $1 trillion company that makes like $6 billion every quarter. Its net income over last year went down 50%. We're seeing a negative 50% move in net income, and the stock just shot up 10% after earnings, or 15%. It's just like, I don't know what world we're in right now, but NVIDIA doesn't care. NVIDIA's in its own universe. It's going crazy. It's a new Tesla. I think it's because of AI. Everything's AI right now. If you say AI, they say AI like 20 times in their earnings call. It's just crazy. It's just like, it's wild. And Microsoft did the same thing, but Microsoft, it's dumping. Microsoft back below that 200-day moving average. Amazon completely dumping. Google ran up to that, and now we're hemorrhaging on Google. Google looks miserable. Apple, we just lost our 200-day moving average on Apple. Apple is one of my favorite plays right now to the downside. It looks like it's going to come down in a meaningful way. But the volume is a little low on Apple, so we'll wait and see. But I'm personally shorting Apple. I'm personally short on AMD at the moment. NVIDIA, Nasdaq. I mean, these are long-dated contracts. These are looking at April. I think by the next FOMC meeting, we'll get that dose of reality that that inflation, yeah, we're getting inflation entrenched here, and things ain't looking good. But that's what I got for inflation. But I still haven't really talked about unemployment, I should say. And that's really the big one. I think what we'll need to see is we'll have to start seeing unemployment ticking up in a meaningful way before the market can possibly think that these rate hikes are done, because that just, like, it fights the whole narrative that the Fed needs to start cutting rates right now. Because yes, it's painful for the institutions and the banks and the home buyers and stuff, but we're not seeing anyone lose their job. And that is like the main metric for how good is the economy right now. We're seeing nobody getting laid off. We're seeing tech layoffs. We're not seeing real world layoffs. We're not seeing construction companies laying people off because there's no contracts out there. We're not seeing that kind of economic slowdown to push real layoffs. And until those real layoffs come, people aren't going to stop spending money. And that's just the way it is right now. Yes, spending has come down from its insane levels of 2021 and even part of 2022. We're seeing that, but we are not seeing it come down in a meaningful way. And that is ultimately what is going to keep inflation entrenched, is that why wouldn't people just keep raising prices? If people keep getting wage increases, they keep having job security. Nobody is worried about losing their job right now. So unfortunately, people will have to lose their job for this whole thing to start to actually show a little bit of pain. Because right now, what's the Fed going to look at unemployment and be like, yeah, we got to start cutting these rates, man. Things are getting rough. When let's go to unemployment. Things are getting rough. Yeah, right. Look at this unemployment. It's the lowest. You can't even zoom the chart out. It's the lowest it's been since the 60s. I mean, it's unreal. It's absolutely unreal. And until we see a change in that, I just don't see the Fed making any big moves on rate cuts. So that's kind of what I got going for us right now. Price action, we don't look horrendous. We don't look like, yeah, we're just going to rug pull from here, but we don't look great either. I need to see a little bit more movement. Once we start to see everything start to move below these 200-day moving averages, then I become much more bearish. But right now, the S&P and the Nasdaq are still holding those. So until we lose those, I am not completely crazy bearish, but we'll see. We'll wait and see. This week should be a little interesting. But yeah, thanks for watching, guys. This is a bit of a long one. I try to keep these short, but it's so hard to not just ramble on about these. But I just ask you to consider subscribing, dropping a like, drop a comment if you enjoyed. I really appreciate it. And good luck this week. This is not financial advice. This is for entertainment purposes only. Manage your risk to reward. Don't just go 0-day puts. We have to go down on Monday. Wait and see. Be patient. Risk and reward. Very important. I'll see you guys.